Hi all, welcome back. So today we'll be covering study unit 5, which is on the donation tax. It's actually a very simple study unit, not too complicated. So let's get going. So the learning outcomes that we'll be covering today are that we want to firstly identify when when you dispose of a property, whether it's a donation. We want to identify the situation where certain transactions could be a deemed donation. We want to explain which donations are specifically exempt from donation tax. We want to identify the person liable for the payment of donation tax. And then finally, to calculate the donation tax payable on any donation at the applicable tax rate. So donation tax is simple. The only thing that you need to do is you need to firstly define what is property, and then you need to identify what of the property donated. You want to first identify the sum of all the property donated in chronological order. Then you need to determine whether it is a donation or deemed to be donation. Then what you want to do is you want to determine whether any of these donations was an interest-free loan or a low interest loan. And you want to identify if there were any specific exemptions applicable. And then finally, whatever constitutes property that has been donated should be taxed at a rate of 20%. So that's in a nutshell what we'll be covering in donation tax and what you need to know and understand. So donation tax is dealt with section 54 and 64 in the Income Tax Act. And if you want a reference, we'll be covering chapter 26 in the South African Income Tax textbook, 2018 edition. If you have an earlier edition, I think it might be in, you should just have a look at the donation tax chapter. But let's get going. So a donation is levied on a net transfer of assets from one person to another person. So in other words, there has to be a transfer of wealth or a transfer of property. Now this tax fulfills two functions on the asset being donated. Firstly, it's on the normal income tax, which would have been the income derived from those assets, and then also estate duty when those assets are excluded from the estate. So very importantly is you should not confuse donation tax with a Section 18A deduction, which is when you make a donation to a public benefit organization. So that is a specific deduction, and it is dealt with completely differently than a donation. A donation is a transfer of wealth to or assets to from one person to another. Okay, and then when does a donation take effect? So a donation takes effect on the date when all legal formalities for a valid donation has been complied with. So importantly, all the legal formalities has to be complied with. But if you make a donation and there's an oral agreement, then this agreement or this donation will take effect on the date of the delivery of the property delivered. So an oral agreement would be on the date of delivery. And finally, a promise to donate. So this is again kind of a oral agreement, but you're going to promise to make a donation, and this will then take effect when the donor commits in writing and signs the relevant documentation. So you should just take note of when a donation takes effect. Okay, now the levying of a donation tax. So donation tax is payable on the value of any property disposed by a South African citizen in terms of a donation, which is section 54, and is levied at a fixed rate of 20% of the value of the property being donated. So that's section 64. So importantly, non-residents are not liable for donation tax. There's other tax consequences for them. So how do we calculate the donation tax? Firstly, as I mentioned before, is you want to identify the disposal of property by a South African resident. So when you make donations in chronological order from when you made it, you want to identify the sum of the property donated. Okay. Then what we want to look at is this property donated, whether it was a donation or deemed to be a donation. We'll deal with that now. Okay, and then what we also want to determine is whether the donation was an interest-free loan or a low-interest loan, and whether it is treated as a donation. Okay, and then are there any specific exemptions applicable? If yes, then you can deduct the exemption. We're going to deal with that a bit later. And then finally, you will have the value of the donation. So the value of the donation should then be taxable at a rate of 20%. Okay. But before we continue, there are a few definitions that you need to understand, and the most important one is property. What is property? So property is any right in or to property, whether it is movable, so in other words a car, or immovable, so a property, a house, or when it's corporeal, so in other words tangible, can you see and touch it? So again, a car, you can see it. Or incorporeal, intangible, being something like a IP or goodwill or intellectual property, anything like that. You can't really see it, but it does have but it is an asset to you. And whether it is situated inside or outside the Republic. Okay, so property. You just need to know that what it is and how to deal with it. Okay, and just a quick note on this. If you, for example, or the rendering of services for free is not subject to a donation tax because there is no property that is disposed of. That's just you rendering your services for free. Okay, so just take note of that. And a donee, who is the donee? So it's basically the beneficiary under the donation. And this includes trusts receiving the property under donation from the benefit of the beneficiary, and also the donation tax payable by a trustee, which may be recovered from the assets of the trust. So when we deal with trust income, then that will become a bit more clear. Okay, so what is deemed to be a donation? So this is section 8C and 58. So before we do it, we just want to define what is a donation, and it's basically any disposal of property which includes a waiver or of any right. Okay, so a deemed donation is an amount of a deemed donation will be the value of the property less the consideration payable by the person acquiring it. So basically it's so in other words, to understand this best, let's just use an example. So if you dispose of an asset which has a value of 200,000 and you dispose it for 20,000, so you donate it to someone and you tell them that they only need to pay you 20,000 Rand, then the 180,000 rand, so the difference between the actual value and the and what you received, is then deemed, will then be a deemed donation. Okay, so it's basically the value of the property less the consideration payable. Now, just take note that a deemed donation could also relate to restricted equity instruments, so that will be dealt with at a later stage. And then the value of a donation is the fair market value of the instrument at the time. So that's in anything that you've done in your tax law, in accounting, you always want to determine what is the fair market value. So the donation would be on the fair market value, and then reduced by any amount of consideration in respect of the donation. Okay, so an important aspect of donation tax is you need to take note of what is an interest-free loan or low-interest loans, and to trusts or companies. So this is section 7C and D. This is a new section that was introduced within the tax law, basically from the 1st of March, where certain loans or credit advancements to a trust by a connected person to the trust may result in the application of a donation tax provision to such loan or credit. So this is now from the 1st of March 2017. So that's when when we deal with trust, it will also become a bit more clear. But when one of the a person who has a connected person to a trust issues a interest-free loan or a very low interest loan to one of the trustees or beneficiaries, now that is seen as a donation, and there are tax consequences to that. Okay, so what you need to take note of is that the lender, he has to be a natural person or a company granting the loan or when a company grants a loan in the interest of a natural person, and very importantly is that this person has to be a connected person in relation to the trust. Now the foregone interest is then deemed to be a continuing annual donation for the purpose of donation tax. Okay, so when we do an example now, you'll understand, but for an interest-free or low-interest loan, these loans are the interest, the foregone interest, so the interest less the applicable or less the current interest rate, that interest would then be a donation. Okay, and then just take note that the lender may use of the annual donation tax exemption of 100,000 rand. So when we deal with exemptions a bit later, we'll understand that. And this section was basically introduced to prevent the avoidance of donation tax and estate duty through schemes involving trust and interest-free or low-interest loans, because there were many many trusts who took advantage of this, and there weren't any tax consequences to it previously. So that's why this was introduced. So if we look at an example, we've got Cynthia, who created an inter vivos discretionary trust on the 28th of February 2017 by selling a rent-producing property to the trust at its market value of 10 million rand. The purchase price was not paid by the trust, but credited to a 2% interest-bearing loan account. Cynthia's daughter and son are the beneficiaries of the trust. So Cynthia has not used any portion of her annual 100,000 rand donation tax exemption. And then what we want to do is we want to assume that the official rate of interest remained unchanged at 9% during the 2018 year of assessment. So So we want to calculate the donation tax consequences for Cynthia that arises during her 2018 year of assessment as a result of the loan granted to the trust. Okay, so basically what we have here is Cynthia, she created a trust for her daughter and her son, who are the beneficiaries of this trust, and she sold a rent-producing property to the trust to the value of 10 million rand. And the trust has to pay interest on this. It's a loan, and the trust only pays 2% interest, whereas the actual rate, interest rate, is 9%, or the official rate of interest is 9%. So that 7% difference, that is deemed to be a donation. So if we look at, so Cynthia is deemed to have made a donation to the trust on the 28th of February 2018, as the donation is calculated on the foregone interest during a year. So that's basically the 9% less the 2%, so that's 7%. Since the loan was outstanding for the full year of assessment and is assumed that the official rate of interest remained unchanged for the year of assessment, the deemed donation is then 10 million multiplied by 7%. So it's 700,000 rand. That's the actual donation, the foregone interest. So then what we want to do is, from the 700,000, we want to subtract the annual exemption of 100,000, and then whatever is remaining, we want to multiply it to the actual donation tax rate at 20%. So in other words, Cynthia is liable for a donation tax of 120,000 rand. Okay. So just take note that Cynthia is a connected person to the trust, so that's one of the requirements. And then the normal tax consequences are determined by the application of Section 7, which is on Chapter 24 on trusts, which we'll do in the next lesson. Okay, so here's another example. So here we have Penelope. She created an inter vivos discretionary trust on the 31st of August 2017 by advancing a cash amount of 1 million rand to the trust. The amount constituted a loan to be repaid by the trust. The loan carries no interest. Penelope's father and mother are the beneficiaries of this trust. And then on the 30th of September 2017, Penelope sold 50% of the loan account to her brother Isaac, for which he paid her 500,000 rand on that date. So assume that the official rate of interest was 9% during the 2018 year of assessment. So what is the donation tax consequences for Penelope and Isaac in this case? So in this case we've got Penelope set up a trust and she advances a cash amount of 1 million rand to the trust, in other words a loan to the trust. And this the beneficiaries of the trust is Penelope's father and her mother. And on the 30th of September, she sold half of the loan account to her brother Isaac. So we've got two people here. Both of them now, at the end of the year of assessment, has an interest in the trust. So in other words, for both of them, there will be a donation tax liability. So firstly, Penelope, let's look at her. So on the 28th of February, so the end of the financial year of assessment, she deemed to have made a donation to the trust, and the donation is basically the foregone interest during the year. So on the 1 million rand, the foregone interest was 9% because it was an interest-free loan which Penelope donated to the trust. So basically she had, if we look at the date, so on the 31st of August to the 30th of September, so for 1 out of 12 months, she had the full 1 million rand loan. So we want to multiply that million rand by 9% for one month, and then from the 30th of September to the end of February, so that's 5 months, she only earned half or 50% of the loan account. So in other words, the donation made by her is then 26,250 rand. And then Isaac, so he's also deemed to have made a donation to the trust at the end of the year of assessment, and it's calculated as the 50% of the million, so 500,000 rand, multiplied by the foregone interest, which in this case is 9% because the official interest rate is 9%, and this was an interest-free loan to the trust, and he only had interest in this trust for 5 out of 12 months, so from the 30th of September to end of February 2018. So the donation is then 18,750 for Isaac. Okay, and then finally on interest-free loans, the final example, we've got Fani and Shivani, which holds respectively 60% and 40% of the equity share XYZ Pty Limited. And then the company grants an interest-free loan of 1 million rand to a trust. The company is a connected person to the trust at the instance of the shareholders. So yeah, we've got two individuals. They hold a share in. Okay, so the company XYZ made or granted a interest-free loan of 1 million rand to a trust, of which company XYZ is a connected person at the instance of the shareholders. This loan was granted on the 31st of August 2017, and then again the interest rate remained unchanged at 9% during the 2018 year of assessment. So we want to calculate the donation tax consequences for Fani and Shivani at the end of the current year of assessment, and we want to also assume that both of them use their 100,000 rand donation tax exemption. So important to note here is it is a company who made a donation to a trust, but this company is a connected person to a trust. This company has to be a connected person in order for its shareholders to be liable for any donation tax on that. Okay. So if you look at it, the normal interest for this loan. So the normal interest payable would have been 1 million rand multiplied by 9% because that is the official rate of interest, and it's for 6 out of 12 months because it's basically from the 31st of August 2017 when the loan was granted up until the end of the 2018 year of assessment, so 20th of February 2018. So the interest payable would have been 45,000 rand. This was an interest-free loan. So in other words, the deemed donation is 45,000 Rand. So because Fani has a 60% interest in this in company XYZ, then Fani's tax or donation tax liability will then be 45,000 times 60%, it's 27,000 Rand. And Shivani with a 40% interest would then be 18,000 Rand. But because both of them used up the 100,000 Rand exemption, so on this 27,000 and 18,000, we just need to calculate the donation tax at 20%. So Fani has a donation tax liability of 5,400 Rand, whereas Shivani has a donation tax liability of 3,600 Rand, which they need to pay by the end of March 2018. Okay, so that's basically interest-free loans or low-interest loans. So what we want to know, or what you need to take note of, is when an interest-free loan or a low-interest loan is made to a trust, whoever makes this donation has to be a connected person to that trust, and the donation tax liability is on the foregone interest made. Okay. But there are also certain exclusions from the applicable provision, or there are certain exclusions made. So this is basically for trusts created solely for the benefit of minors with a disability, or when trusts or companies fall under a public benefit organization or small business funding entities, loans used to fund the acquisition of a primary residence, and loans that constitute affected transaction and are subject to transfer pricing provisions. And finally, loans by trust created solely set up as a share incentive scheme. So these are all exclusions in which there is no donation tax liability. So you can't calculate that. Okay. So the most important one is basically trust set up for the benefit of minors with a disability. Okay, and that brings us to specific exclusions. So remember that we've defined what is property, what is a donation. We defined what is a donation or deemed to be a donation. We looked at interest-free or low-interest loans, and then the final step before we calculate the donation liability is we want to deduct the specific exemptions. Okay. Now the first one is a donation to the spouse of a donor under a duly registered nuptial or post-nuptial contract. So when you make a donation to your spouse, this is specifically exempt. And also to the benefit of a spouse of a donor who is not separated from him under a judicial order or deed of separation. So again to your spouse, but you are not separated, as a donia mortis causa, so basically a donation made in the contemplation of death by a donor, in terms of which a donee will not obtain any benefit thereunder until the death of the donor. So that's an important one. And a donation which is made and which has a provision that it will be cancelled within 6 months from the date upon which this donation took effect. So yeah, anything that will be cancelled after a set period that is not that is specifically exempt. And then finally, any donations made by traditional council, traditional communities, or any tribe. Those are specific exemptions. Okay, and then we also have any property outside of the Republic, So if this property was acquired before the individual who makes this donation became a resident of the Republic, or if this property was inherited from a non-South African resident, or if it was out of funds derived from disposal of or from a revenue from replacement properties. Okay, so that's an important one to take note of. And then a donation made by the government of the Republic, any political party, a public benefit organization, a club, a small business funding entities, share block companies, or institutions. So when any of these institutions makes a donation, it is exempt, specifically exempt. And finally, we've got a voluntary reward. So this is derived from services rendered or termination of services rendered or taxable fringe benefit. So that's basically if you work for 20 years at a company and you get a cash or you get like a watch or some cash from the company because of your services, that is not a donation, or that is specifically exempt as a donation. And in any public company who makes a donation, that is also a specific exemption. Okay, and then there are some general exemptions. So this is basically what you qualify for, what amount you can exempt from the value of the donation. So for a company or any institution or trust or company other than a natural person, when they make a casual gift up until the value of 10,000 Rand, that 10,000 Rand will then be exempt. And then this amount has to be adjusted proportionally. So if we look at an example, the year of assessment of a company is from the 1st of March 2016 until the 28th of February 2017. It then changed its financial year end to 31 December, in this case 2016. So what are the maximum amounts of its casual gift that would be exempt from a donation tax in the year ending 20th of February 2017, the period ending 31 December 2017, and the year ending 31 December 2018. So because it's a company, it's not a natural person, then that means that it only has an exemption of 10,000 Rand on any casual gifts made, but this has to be adjusted proportionally. So if we look at the financial year from the 1st of March 2016 to the 20th of February 2017, so that's basically for a year, 10,000 Rand multiplied by 360 over 360, so that's then 10,000 Rand. So the full, you may deduct the full exemption, this company. But now, this company changed its financial year end to 31 December 2017. So then if we look at the current financial year, or a year of assessment, which is then from the 1st of March 2017 to the 31st of December 2017. So that is basically 9 out of 12 months multiplied by 10,000. So now you are limited to, your general exemption will only be 8,384 Rand. Okay, and then the final one is just now from the 1st of January to the 31st of December, so that's a full year, so your general exemption is then 10,000 Rand. Okay, and then as you saw earlier in some of the examples, for a natural person, you an exemption of 100,000 Rand on the sum of all property donated during the year of assessment is exempt. And also for a natural person, this amount does not have to be decreased proportionally if the year of assessment is less than a year. So the important to note here is that you need to add all the property donated, and then on that you are exempt, or your first 100,000 Rand is exempt. So if we look at this example, we've got Samuel, who made the following donations during the year of assessment ending 20th of February. So firstly, an amount of 18,000 Rand to his brother on the 25th of March. Then an amount of 71,000 to his mother on the 10th of July. And then an amount of 15,000 Rand to his son on the 6th of February. So what of these amounts will be subject to a donation tax during the year? So let's first add all of this together. So if you add all of it together, then you will get 104,000 Rand. So let's show 100,000 Rand general exemption. So that means you are only liable to 4,000 Rand donation. So you'll calculate 20% on that 4,000 Rand. But here they want to know which amounts will be subject to donation tax. So firstly, the amount to his brother, that will not be, because it's within the 100,000 Rand exemption. Then the 71,000 Rand to his mother, it's also within. And then to his son, the first 11,000 Rand will not be exempt. Okay, so important to note here is that you just need to add the sum of all property donated, and then on that you've got a 100,000 Rand exemption, and this does not have to be decreased proportionally during the year of assessment. Okay, now what we want to look at is the valuing of property other than a limited interest. So so how do we value the property that's being donated? So essentially what it is the fair market value. So it's the price that a willing buyer and a willing seller will agree upon will agree upon in the open market. So the fair market value. So that's the value of the property being donated. But very important thing to note is that immovable property on which the bona fide farming activities are carried out in the Republic, this fair market value is then reduced by 30%. So any property on which there are farming activities, the fair market value, you need to subtract 30% if a donation is made on that. And then if the willing buyer and the willing seller cannot agree upon a fair market value, then the commissioner will determine what the fair market value will be. If he, for example, believes that the value is too low. Okay, now what we want to do is we want to distinguish between a fiduciary interest and an usufructory interest. So fiduciary interest is created when a person donates or leaves property to another person. So in other words, the other person is the fiduciary, on the condition that the ownership will pass to a third person, who is the FDE commissary, on the death of the fiduciary. So let's look at it again. So that's when a person donates or leaves property to another person. So the other person is the fiduciary. So on the condition that the ownership will pass to a third party on the death of this of the fiduciary. So what does this mean? It means that the fiduciary has the full right of use of the property, but he is unable to dispose of the property. He may only dispose of his limited interest in the property. Okay, because his limited interest is on the condition that once he dies, then it gets transferred to a third party. But if the third person or the fiduciary dies before the fiduciary, then the full ownership passes to the fiduciary. Okay, so this is normally a donation made in a trust to the person's children or something like that. Okay, and then what we have is the usufructory interest. So it's a bit of a handful, that word. So, so basically what this means is the ownership can be split into two rights. The first right being the right of use, which is called the usufruct, and then the second right is the right of ownership, called the bare dominium. So the person who has the right of use, or the usufruct, has the right to use the property in any way he wishes, and he may earn income from this property. However, he may not dispose of this property. Whereas the bare dominium, he is subject to the usufructory interest. In other words, he has no right of the use of income until the usufruct dies. So the bare dominium has the right to dispose of the right of ownership. Okay, so we've got so ownership is basically split into two rights: the right to use, called the usufruct, and the person with the usufruct has the right to use the property in any way he wishes. He may earn any income he wants from this property, but importantly, he may not dispose of this property, because the bare dominium has the right of ownership of this property. He therefore has no right to use or income of this property until the usufruct dies. Okay, but what the bare dominium may do is he may dispose of his right of ownership. So when we value a donation subject to a usufruct, we first want to determine the fair market value of the property over which the interest is held. Then there is an annual, then the value of the interest has to be multiplied by 12%. So that's important, is you need to remember that 12%. Then we want to establish the lesser time between the period over which the limited interest is to be enjoyed, so the life expectancy of the donee, or the set period of the usufruct, and the life expectancy of the donor. So basically we want to, whatever time is less, so the life expectancy of the donee, so who receives this donation, or the life expectancy of the donor. And then finally we want to capitalize the annual value over the shortest period of these two life expectancies by multiplying the present value of R1 at 12% by the annual value as per table A. Okay, so in your textbook or in the SILP book, so in the end, Appendix D of your SILP book, which has the expectation of life and present value tables, there you can find this value. So if you look at it, so it's basically just a table of your age and what your life expectancy is, whether you're male or female at that age, and then it's the present value of the R1 per annum for life. Okay, so if you are 20 years old and you are a male, then your life expectancy, you are expected to live for 47 more years, and then the present value of R1 per annum is then 8,294. Okay, and it just has these summaries for you. Okay, so that's table A, and in table B is just the present value of a R1 per annum capitalized at 12% over fixed periods. So if there's a fixed period, then you need to look at table B. Okay, but we'll look at an example now. Okay, the only thing to take note of is you need to determine the fair value of the property over which the interest is held. We want to calculate the annual value by multiplying the market value by 12%, and then we want to establish the lesser life expectancy of the donee and the donor, and then that will be capitalized by the present value of R1 at 12% at the annual value. Okay, so we look at it in an example. We've got Omar donate to Sabelo, both of them are males, a usufructory interest, so in other words, ownership of a property, for life in property with a fair market value of R1 million. Omar's age at his next birthday will be 56, and Sabella's age would be 33. So who has the shortest life expectancy? In this case, it will be Omar. So Omar is expected to die first. So what is the value of the donation for the purpose of donation tax? So firstly, we want to calculate the annual value of property. So it's the fair market value of the property being donated, being R1 million at 12%. So the value of the property is then R120,000. Then what is the lesser between Omar's life expectancy? Then we want to determine whether the donor or donee has the shorter life expectancy, and in this case it will be Omar, who has who is 56 years of age, and he is expected to have a shorter life expectancy. So we want to get the present value factor of a R1 a year capitalized at 12% over Omar's life expectancy. So if we look at table A, he is 56 years of age, so because he's male, he's expected to live for 17.18 more years. So the present value will then be 7,144. Okay, and then this then has to be capitalized by the annual value of property. So the 7,144 we're going to multiply by 120,000 Rand. So the value of donation for donation tax purposes will then be 857,000 Rand. Okay, and then what they did here is they just looked at Sabelo. If his age was 67, then the annual value would have been capitalized over Sabelo's life expectancy, because he has a shorter life expectancy than Omar. So if you look at 67, sorry about that. So it's 67. So because he's male, Sabelo is expected to live 10.76 more years, so it will be capitalized at 5,871.65. And then the 120,000 Rand, we want to capitalize the value of the usufructory interest. So then it will be 704,598, which is the value of donation. Okay. Okay, so the next one we have Fadizizu, who's a male and is married in community of property to Lebogang, who is a female, and he donates the usufructory interest in property valued at 2 million Rand to Sepo for life. This property is not excluded from the joint estate of Fadizu and Lebogang, and Fadizu's age at his next birthday is 46, whereas Lebogang's age would be 45, and Sepo's age is 35. So what is the value of the donation for tax purposes? So basically what we have here is we've got Fadizo and Lebogang, who are married in community of property. So under 2 million rand, we will need to calculate a 50% interest for Fadizo and Lebogang. And both of them will then have a 50% donation liability on the 2 million rand. Okay, so the first step in determining the valuation of the usufructory interest is to determine the annual value of the property. So the total property is 2 million rand, multiply by 12%, so it's in 240,000 rand. Then we're going to split this donation between Fadizo and Lebogang because they're married in community of property. So for Fadizo, he's male. What is the lesser between his age and Seppo? So Fadizo has the shortest life expectancy. So again, you're just going to go to the table A, and you'll find that Fadizo's life expectancy is 24.58 years. And then from table A, the present value factor will then be 7. So it's then 7.81924. So this we're going to multiply by 240,000 rand, which is the value of the property, and the 50% interest because he's married in community and property with Lebogang. So the value of donation by Fadizo for tax purposes will then be 938,309 rand. Now if you look at Lebogang, so the shortest life expectancy between Lebogang, whose age will be 46 at her next birthday, and Seppo at 35. So Lebogang has a shorter life expectancy. So because she's female, from table A, the present value factor of 1 rand a year capitalized at 12% will then be 8.08527, and then the capitalized value of the usufructory interest is that multiplied by the value of the property multiplied by 50% interest. So the value of donation by Lebogang for donation purposes will then be 970,232 rand. Now for Fadizo and Lebogang, both of them are entitled to the general exemption of 100,000 rand each. Okay, here we've got another example. We've got Whitney. She grants a fiduciary interest in property valued at 2 million rand to Mariska for 12 years for life, whichever is the shorter period. Whitney's age at her next birthday is 60 and Mariska is 50. Determine the value for for purposes of donation tax. Okay, so in this case, the donation was made over a fixed period, so it's over 12 years or for life. Okay, so that means we'll have to look at table B in this instance. So the first step is always to determine the annual value of the property at 12%, so it will then be 240,000 rand, and then this amount has to be capitalized over the life expectancy of Whitney or Mariska, or over the fixed period, whichever is shortest. So we've got Whitney, who is 60 years, and Mariska is 50 years, or the fixed period is 12 years. So what is shortest? Okay, so Whitney, she's 60 years, so because she's female, her life expectancy is 18.78. Mariska is 50, so her life expectancy is 26.71. So in other words, the fixed period of 12 years is the shortest period. So we're going to look at table B. Then table B, 12 years. So the present value on this fixed period is then 6.1944. Okay, and that we want to capitalize of the fiduciary interest. So the value of the donation for donation tax purposes will then be 1.486 million rand. Okay, and then they also just have a note here that if the fiduciary interests were donated for a term of 20 years, then because then Whitney, with a shorter life expectancy, will then use her, capitalize it to her life expectancy. Okay, so table A. Okay, so that's looking at the fiduciary interest when you donate a property, but how do we value an annuity? So annuity is basically valued by capitalizing the amount of annuity at a rate of 12% over the shortest of the donors or the donee's life expectancy, or if it's held for a lesser period over this lesser period. So it's exactly the same as we did now, as we did previously when we donated property. So we look at an example. We've got Ranesh, who's a male. He grants an annuity of 200,000 Rand to Marco, who's also a male, for life. Renesh's age at his next birthday is 55, whereas Marco's age would be 60. And we want to determine the value of the donation for purposes of donation tax. So the annuity must then be capitalized over the life expectancy of the donor or donee, whichever is shorter. So in this case, which we have Marco, he has a shorter life expectancy at 60. So if we look at 60 from table A, so his life expectancy is 14.61. So we capitalize at 6.74206. So the 200,000 Rand annuity is capitalized at 6.74206. So the value of the donation for tax purposes is then 1.348 million. Okay, in this example, they just look at whether it's a fixed period for 10 years, so that will then have a shorter life expectancy. So then you just look at table B. So the value of for donation purposes will then be 1.13 million. Okay. So the final thing to look at is the valuation of the bare dominium. So remember, the bare dominium is the right of ownership. So how do we determine the value? So firstly, we're going to calculate the annual value of interest by multiplying the fair market value by 12%. Then we're going to determine the period of time for which the usufructuary is to enjoy the usufruct. So in other words, the expected lifetime of the usufructuary, or the lesser period if the usufruct is to be held for a lesser period. So if there's a fixed period, then we're going to multiply the annual value by the present value of 1 Rand over the period of the usufruct. And then we're going to deduct the amount calculated in step 3 from the fair market value to establish the value of the bare dominium donated. So everything is more or less the same as what we did previously, apart from this final step where we take the value that we determine and we need to subtract it from the fair market value. Okay, so if we look at an example, we've got Ricky. He donates a farm. Remember, with a farm, the value is reduced by 30%. That is what we did here in this when we looked at the valuation of property. So immovable property on which the benefited farming activities are conducted in the Republic, the fair market value is then reduced by 30%. So just take note of that. Okay, so he donates a farm on which the benefited farming activities are carried on in South Africa that is subject to the life usufruct of Ben, who's a male, and Aiden, who's also a male. The price, which can be obtained between a willing buyer and willing seller, so that's the market value, for the full ownership of the farm is 2 million rand. Ben's age at his next birthday is 58 years of age. So we want to determine the value of Ricky's donation to Aiden for purposes of donation tax. So firstly, what is the value of the property? So the farm is valued at 2 million rand, that's a fair market value, less the 30% reduction. So in other words, the fair market value is then 1.4 million, multiplied by 12% gives us an annual value of property of 168,000 rand. So because this was donated to Ben, who is the usufruct, we want to look at his, we want to get the present value factor of the 1 rand a year capitalized at 12% over his life expectancy. So at 58, we go to table A and we find that the present value is 6.952, and then we're going to capitalize that at the Ben, who is the usufruct's interest, so at the 168,000 multiplied by this present value gives you then a value of 1.167 million. That we need to subtract from the property, the full ownership, so less this amount less the 1.4 million, so the value of the donation for donation tax purposes will then be 232,000 rand. Okay, and then in this example here, they do the same, but now it's a fixed period of, they say 7 years and 4 months. So in other words, we just need to, that is a lesser amount. So we're going to have a look at table B, table D at, table B at 7 years, and then if you calculate that, then you'll find that the value of the donation for donation tax purposes will then be 633,282. Okay, so that's basically it for donation tax. The only thing to remember here is the process that you need to follow in determining your donation tax liability. It's very simple. What you want to do first is you want to determine what is the total value of property being donated. Then, is it a donation or deemed to be deemed to be a donation? Are there any low interest loans or interest-free loans? If so, then it has some consequences that you need to take note of. Then you're going to see whether there are any specific exemptions, less your general exemption for natural person, that's 100,000 rand. For other than a natural person, it's a 10,000 rand on casual gifts. And then whatever amount is remaining, we're going to calculate a tax liability of 20% on that value. Okay. So let's look at a final comprehensive example. We've got on the 1st of May, Amugelang Wawa married out of community of property, celebrated his 60th birthday with a lavish party to which all of his friends and family and even a few of his employees were invited. Amugelang, is very wealthy and loves playing board games and video games. he decided that instead of guests having to bring birthday presents for him, he would be hosting several games at the party and award substantial prizes to the winners of these games. During the course of the party, Amogelang awarded the following prizes. It seems like very nice prizes. I would have loved to be part of this party. So the first prize, or the first donation, was made to Adam, who's a male, and he won a competitive game of FIFA on an Xbox One. It was also awarded 10 trucks, of which Amogelang has used in one of his manufacturing businesses. Amogelang had purchased the trucks at 150,000 Rand each in 2012 and had claimed the full cost in terms of wear and tear allowance for normal tax purposes against the income from the business. The market value of these trucks currently on the 1st of May is 90,000 Rand each. So what is the donation tax consequences on this? So if we look at it, we've got so the first thing we want to do is we want to determine the value of the property. So to Adam, on the 1st of May, he donated 10 trucks at 90,000 Rand each. So in other words, the donation is in 900,000 Rand. So that's quite simple. Okay. The next prize or donation was made to Bernie, who is a male. He's an accountant at one of his businesses, and he was a winner of a game of Scrabble. Amogelang awarded 10 iTunes gift vouchers to the value of 500 Rand each. So this is also very simple, just 10 vouchers at 500 Rand each, so 5,000 Rand donation. Okay, and then we've got Auske, who's a female. She was the winner of the Monopoly game, and the prize to her was a house with a fair market value of 900,000 Rand. And then Auske will receive this house, but is subject to the lifelong Usufruct therein awarded to Fergie. See the note below. So Fergie, she's 51. She was the winner of the tennis game on the Wii console, and she has a lifelong use of the property awarded to Auske. So in this case, Auske is the bare dominium. She has the right of ownership, whereas Fergie is the usufruct. She has the right of use. So how do we deal with that? We want to determine the value of this property. So what is the value of the property? So for the bare dominium, so it's based on the life expectancy of the usufructuary, who is Fergie. She has the right of use of this property. So the property is valued at 900,000 Rand. We need to capitalize it at 12%. So the annual value is 108,000 Rand. What is Fergie's age at her next birthday? She's currently 51, so her age at her next birthday will then be 52. If we look at the table, 52, Fergie has a life expectancy of 25.6 years, so we need to, the present value will then be 7.846. So if we go to the value will then be 847,480. Because Auske is the bare dominium, we need to subtract this value from the full market value. So the bare dominium value will then be 52,582. So that's the donation made to Auske. Okay, and then Fergie, she has the right of use of this property. And it is on the donor's life or the donee's life expectancy, so whichever is shorter. So Fergie is 51 years of age, so her next birthday will be 52, whereas Amogelang is 60, so he has the shorter life expectancy. He's male, so you're going to look at, it's going to go to 61, so he has a life expectancy of 14.01 years versus Fergie, who are at 25 years, so going to use Amogelang's present value factor, multiply by the Usufruct value donated, so at 108,000 Rand. So the Usufruct value donation amount is then 716,000 Rand. Are there any other donations? Okay, and then Amogelang also made the following other donations during the 2018 year of assessment. On the 1st of August 2017, he made 70,000 Rand donation to his son to be used by him for a holiday, but he returned this 70,000 Rand 5 months later. Okay, so on that 70,000 Rand, because it was returned within 6 months, this is specifically exempt, remember, from that list. So we're not going to have any donation liability on that. Okay, and then Ken Owens, a friend of Amogelang, owned Amogelang 57,500, but on the 1st of November 2017, Amogelang accepted 20,000 Rand as a final and full payment of his debt. So he had to write off, how much is it, 57,500. Okay, so yeah, firstly what we want to do is we want to determine the full amount of property donated, which was 1.6 million, less the exemption of 100,000 Rand. So then the value of the property donated on the 1st of May is then 1.5 million, 1.573 million, multiply by 20%, so the donation tax will then be 314,727. Okay, and then it's the cancelled, the donation cancelled because it was returned within 6 months to his son. Then the debt written off, so it's the 37,500 at 20%, so it's 7,500. So this 100,000 Rand is the general exemption on all property donated. This debt written off, that's not really property donated, so that's why it's not included in this calculation. So that's why it's not subject to the 100,000 Rand exemption, general exemption. So just take note of it. The general exemption for a natural person is 100,000 Rand on property. Okay. Okay, and then the final donation made was 300,000 Rand cash to his wife on Christmas. Yeah, his wife would be 65 years of age. He is married out of community of property, but this is specifically exempt even if it's out of community of property, because it's on that list that we went through earlier. Okay, so yeah, on this example, what you have to do is you want to determine the sum of all the property donated, less your general exemption, and then these are some specific exemptions that was applicable. Okay, so that's basically it on donation tax. As I mentioned, it's not that difficult of a section in the Tax Act. You just need to look at the principles of this, and you need to remember donation tax is liable at a fixed rate of 20%. Okay, cool.